Hello, welcome. Easy for us here. I believe you are doing well. So today we are looking at um, premium and discount pricing and dealing ranges. All right. It may sound familiar. Maybe you know it already, but if you know it already, that is fine. But for those of you who don't know it, is one of the things that you can inculcate into whatever trading strategy that you have, and it's going to help you to avoid trading at places where you are most likely to be liquidated. All right. So there's liquidity all around the markets because every high or low that you see, previous session high, previous session low, previous day high, previous day low, previous month high, previous month low, previous week high, previous week low, all of those things creates liquidity in the market. And you know that without liquidity, the market will not move. All right. So there are two things that helps the market to be healthy. And one of the things is liquidity, and the other thing is volume. All right. So liquidity is the amount of money that is being pumped into the session at a time. All right. So let's go straight into the video. So we're talking about the premium and discount pricing tool and dealing ranges. So first of all, let's talk about premium and discount pricing. You know that when market is trending, all right, and each time we keep breaking the high, this time we are looking at an uptrend, all right. Each time market breaks a new high, we are going to deploy our premium and discount to measure our dealing range. And what I need you to get is that in premium, we look for sales, and in discount, we look for buys. So this is regardless of your bias. All right. So if you understand this, then you can employ it in your trading style, and it can help you boost your confidence when you are taking counter trades. All right. So we will have a look at that. So we have price breaking this high here and then establishing a new high here. And then we went ahead, broke that high, established a new high. We went ahead and broke that high, established a new high. So between this low and this high, between this low and this new high that has been created by breaking the previous high, we call that a dealing range. All right. So this will be your low and this will be your high. So in between this range is what we call your dealing range. So this becomes your dealing range high and your dealing range low, which means that price may have to leave this zone, either to the upside or to the downside. But here we are looking at a bullish scenario. We are looking at a bullish scenario. So what we are saying is that um, let me go back to my charts. Where is it? All right, so I'm finding some difficulties here, but let's see. Good. So what I was saying was that anytime price breaks the high, we are looking at a bullish scenario here. So anytime price breaks a high from this low by moving up in that fashion, giving us a new high, we are going to measure from our dealing range high to our dealing range low and find our premium and discount prices. That is to help us. That is, in this scenario, we are bullish. Okay, so we want price to return to discount. That is where we buy. So anything above the discount pricing, we are not interested. Price may present us a buy opportunity around the discounted zone. I mean the premium zone or above the discount zone. We will not be interested in that. We will only be interested in the discount for our buys. All right. So we're going to demonstrate it and you'll see how effective it is. Now, the tool we use is the Gun Boss, which you can find here. You can likewise apply it to Forex. Today, we are looking at synthetics, all right? So on your toolbox on your left, the third box, just right-click the arrow and then scan through. You look for Gun Boss, this one. I have added it to my favorite toolboxes. So you can just click the star to check it up and it will be added to your toolbox. So when you click and you drag down, that is what you're going to have. This is what you are going to have on your screen. So let me show you the settings for the premium and discounts. Let me apply the default. So when you draw it at first, it looks like this. You can double click it or right click and select settings. And then you go to, this is not it. I want this one. Good. You see all these ones have been checked. So we are going to uncheck all of them from the top. Uncheck all of them. All of them. And now we are going to check the ones we need. So we check the 0 to bring it back on. We check the 5, then we check the 1. This is all that we need. Then the values, you can write labels. You can choose the right labels. And then if you like the background, you can choose background and you can change the colors for the background. So let me use something red for the top and then maybe green for the bottom. So the red will signify a sell zone and the green will signify a buy zone. So let me reduce the opacity. Good. Good. Click OK. So this is all we need. So anytime price breaks a high and forms a new high, we are going to measure from the new high to the old low. All right. From the new high to the old low. So you see 0.5 here. That is called the equilibrium, the middle point. Sometimes when price is at the middle point, mostly you see consolidations around the middle point. Mostly, if you like, you can backtest and check. And then what we are interested in, if we are looking for buying opportunities, we are looking for price to drop into discount below the 0.5% after breaking this high. Then we look for areas where price can react from to give us a buy continuation. That is where we can deploy either our FIB tool. Anyway, I've done a different setting for that. I'm using standard deviation. You can deploy our FIB tool, or you look for your order block, your demand zone, your fair value gap, whatever strategy that you use to find your buy entry, whether candlestick confirmation, you can use that once price is within the discount of the range. And it helps you because anytime price is in premium, price may have to retrace into discount before continuation. It happens a lot in the market. And there are times it doesn't return, but most often it returns for buyers to reposition themselves again and continue buying to the upside. All right, so a recap, you just need your Gun Boss, and then in an uptrend, you drag from your new high to your old low, In a downtrend, you drag from your old low to your new high, and in that fashion. All right, so you'll be going to the chart very soon. So I told you in a premium, you look for sales, even though it's buying, but you are looking for counter trends towards the discount area. So when you're looking for counter trends in a bullish market, and maybe you catch a sell from here, you are very mindful of where you set your target, because if you set your target beyond the discount zone, the probabilities are that because we are in a typical bullish market, price may react from any demand zone, fair value gap, order block, or whatever strategy you use, and then give you that buy continuation. So when you are taking a counter trend and you use your premium and discount to, just make sure that after price trades through the 0.5, you are looking for opportunity to exit, and then you reposition for the trend continuation. All right. So that will help you a lot. That is if you do counter trading. Some people have resorted to not trading counter trends. That is up to them, right? So let's go to the chart. Let me show you some chart examples. So this is this jump 75. Okay. This is the 4-hour time frame. Let me go to the 1 hour and see what we can find. Great. So beginning from the bottom here to the upside. So we are looking at this range here. Okay. And we are going to deploy our premium and discount too. Like I said, it's not always that price traces into discount or premium, but most often it does. So what we can see is that we had a low here, we had a high here, we had a higher low, and market gave us a higher high. All right. So if we are using our dealing range, then this is our dealing range high, and this is our dealing range low. All right. So this was our high to our low. And you could realize that when we draw our discount to from here in premium here at the top, market was selling. When it got to the discount, that was when it started buying to the upside. So we broke this high. Once this high has been broken, we have a new dealing range. That is from this low, new low, higher low, to what? This high that has been formed. So this becomes our dealing range after breaking this high. So what were you to wait for? You were to wait for price to return to discount, but then you have to draw it first from the high to the low here. So we said that any point above this area, 0.5, is equilibrium. All right. And below that is discount. So once we had that break, we were waiting for price to return into discount, but price didn't come back into discount, and then we had a push away from there. So you didn't have an entry if you were going to use the premium and discount too, and that is fine. Sometimes you miss entries, but you could see that when we use the previous dealing range and we use the current one, actually the current one, price had not broken the high anyway. We had this high broken. With this move. So our new dealing range became this one. After we broke that high here, this was a low, this was a high, this was a higher low, a higher high, higher low, higher high. So we kept breaking in that fashion. So after price broke this high, it returned into the range, and look at where it came. Let me put it here. Put this one. Price left the top zone, came to the bottom before buying. When we go to a lower time frame, like the 15 minutes, to be quite clear, where price returned to before buying. So on our 15 minutes, we could see that after markets took out this previous high here, gave us this new high. This became our new dealing range. This one here to this one here became our new dealing range. So if you are drawing your premium and discount from the top to the down here, we say that at the top here, you are not interested in buying. Allow price to drop into discount. And you could see that price dropped into discount before continuing. All right. So after price dropped into discount and continue to break this high, we have a new dealing range. And it is from this high, to this low became our new dealing range. So this is our dealing range high. This is our dealing range low. So you pick your premium and discount to measure from the high to the low. Make sure to be precise about it and allow price to drop. If price decides to give you any entry above the 50%, 0.5%, you are not interested in buying. Allow price to drop deeper into discount. Anywhere below the 0.5, if you find any area that price can react from and go to the upside, you can take that buy. And according to my strategy, this becomes an inversion fair value gap here. Which price used? All right. An inversion fair value gap. There was a fair value gap which price violated. First used as support, came back again and used that same thing place as support, and then went up higher. I believe you are getting the scenario and everything that I'm teaching you. So the premium and discount tool comes in very handy. It helps you to avoid being dragged down into deep losses before price may reverse, by which time your account may not survive the drawdown. All right. So even if it may survive, some of the things can be avoided. So we had price break this high like I did in our example. And this was the low that broke that high. All right. And this was the new high that was established. So this low to this high becomes your new dealing range. So you pick your premium and discount to from the top to the bottom, and then allow price to drop below this midpoint, which is the equilibrium point. And price drop deeper and even went below this order block a bit. But as price went below that, if you go to a lower time frame, you could see that price was just reacting off of this order block somewhere here. 1, 2, 3. All these consecutive candles are order blocks. So price used the midpoints, which is going to be something that I'll be teaching later. Maybe you know about it, but for those who don't know, sometimes when you have a big order block like that, you can enter from the middle point. Midpoint is called the mean threshold. That is if you are doing ICT stuff, all right? So, but even if you are not doing ICT and you are still doing demand and supply, you can still deploy these things. It's just a matter of transfer of knowledge, all right? So you could have entered from here and then maybe you aim for this high or whatever. We are not doing aiming for targets. So let me go back to my video about, so we had this dealing range low. Sorry, it was this one and this one. And after price came into discounts, it went ahead, broke the high, gave us a new high, retraced. So in this scenario, you could see that price did not give us that deep retracement. After we broke the high here with this move, price did a small retracement, but it didn't come into discount, and you are not interested, you are not participating. So you allow this one to go. And if it had come there, look at where you could have taken your entry. This is a demand zone. These two down close candles are demand zones, which price did not visit. And look at it. And price came there in the future. There was a little reaction there before that sell continuation there. All right. So that is the premium and discount tool for us. So let's look at a bearish scenario where we can deploy it. So from this side, we are looking at where we can deploy it. So we had this low, which was our last low before price putting this high. And we had market breaking the low from this side to this side. So these two became our new dealing range. So from this high to this low, you measure and allow price to come above the 0.5, the midpoint. You could see that there is a small demand zone at the immediate discounted area, and price went above that just a bit and then dropped to sweep this low as your target, your immediate target perhaps. And after price established this new low, there was a little pullback before a break. And you could see that the pullback was not strong enough into discount because this becomes our new dealing range. And price never went into discount again. I mean, premium, sorry. When we are selling, price must return to premium. In discount, you don't take any action, but in premium, you look for sales. So this one we are looking at sell buyers. So price never returned here and you are fine. All right. So we had this high, this low. Price broke the low and then gave us a new low. So this becomes your new dealing range as price was going down. This becomes your new dealing range. And if we were to measure, you see that price came into deep premium before it sold off again. And when it sold off, it sold from here, broke this low and established this new low before pulling back. So you deploy your premium and discount from this high to this low, allow price to come deep. And what did price find there? It found we had this order block in deep discounts. I mean premium, which price used. All right, let me delete this one here from here. So we have this order block or demand supply zone, if you like, that price used in premium to continue the sale, breaking this low. After we break this low, we have a new dealing range. From this high to this low is our dealing range. So we use the premium and discount from this high to this low and allow price to come into premium because we are sell biased. And what did price find in premium? We had this fair value gap. All right. I think that is the only thing we have here. And we have this fair value gap as well. So it's kind of a balanced price range. All right. Which price returned into and then sold off, breaking this low. So from this high to this low is our new dealing range. All right. If you sold from here, your target is to take this low. So from this high to this low is our new dealing range. So you measure from this high to this low and allow price to retrace into premium. And in premium, what did price find? We have this order block here, which price just used. So you could have series of places which market can react from as your point of value or area of value or point of interest or whatever, depending on your strategy. So price succeeded in breaking this low from where? From this high and established a new low, sorry. And price had to retrace. So after every impulsive move, there can either be a retracement, a consolidation, a retracement or a consolidation before continuation or reversal. So in this scenario, we had an expansion that broke the low. So price had to retrace into what? Premium. So from this high to this low, where is our premium range? This is our equilibrium range, this particular line. And above that is our premium range. And price never came there. So you missed that. So if price had come into discount, you have this order block here that price could have reacted from. Or we have this candles low as a breaker, which price could have also reacted from, but it never came there. Pushed down a bit, and we had a market structure shift right here. So we turned bullish from this down move. after we took liquidity here, and then further took liquidity below these lows, the candle wick just swept the lows and gave us our first market structure shift here. And then confirmed it by breaking this one as well for us. So we turned bullish. So after breaking this high, price put in what? A new high. This was the high, swing high. From this low to this high became our dealing range. And you draw from your low to your high. Sorry, you can use your high to your low. And you were to allow price to drop into discounts, which it never did. So you are not bothered. You didn't participate. And look at what market did. After it took out this high, gave us a new high, took out this high, gave us a new high, but look at it. It came to break the low, retrace into this other block, and then change direction completely, started selling again. So after price put in this high and broke this low, it gave us a new low. You take your premium and discount to, from this high to this low, becomes your dealing range. And you allow price to come into premium. And in premium, for me, I do fair value gaps. So I could have found this perhaps. Yes, it's easy to see some of these things when you are backtesting, accepted. But for the fact that I've been able to see it while backtesting, it's a plus, all right? So yes, that is it. That is how you use your premium and discount to, because from here we switched bearish and we're looking for sales within premium, and take your sell, your stop loss above the range. Don't be too stingy with your stop loss, all right? So maybe target this low side. You had a beautiful trade and price has been going down in that direction, all right? So that is how we use our premium and discount to follow the trades. If you like the video, make sure that you subscribe. Give me a thumbs up or give me a comment, a positive comment. Negatives are not welcome, please. You can criticize me, but don't put up any negative comment there. Not for any reason, all right? We are in this space to help each other, so there's no point witch hunting anyone. So thank you so much. This has been Easy Forex. See you again. Bye-bye.